Does this data tell us it's time to buy risk assets and stocks again? Now, we like to look at all types of indicators. Some indicators are leading indicators, telling us what's going to happen next in the stock markets, and some tell us what happened. They're lagging indicators. And we're trying to look at lots of indicators, but some assets specifically are like the proverbial canary in the coal mine, where they tell us what is going to happen. And over the last week, we've seen these assets, certain types of assets, moving in a big way. And they seem to be telling us what the data is telling us, and that is it's time to start buying stocks again. So in this video, I'm going to break down what charts and data I'm looking at and I'm referring to, which assets are pumping, confirming what the data is showing us, and why it might be time for you to start buying risk assets and stocks again. Let's break it all down, so let's go. All right, welcome back. If you're new to the channel, my name is Mark Moss, and I make these videos to change the way you think about money, because almost everything you're hearing and seeing from mainstream is probably wrong. It's missing context, and if you get the right information, you're going to succeed. Look, we have lots of hope and prosperity in front of us, but we have to navigate this correctly. So let's see what's going on in the markets with our favorite canary in the coal mine asset. What's it telling us? Okay, the big thing, obviously, inflation, deflation. I'm like a broken record over here. Inflation, inflation, inflation. That's all we hear. But now we might have another problem, and that is deflation or even disinflation. So let's take a look at this. So when we're measuring inflation, CPI, Consumer Price Index, it's typically looked at year over year. So they're comparing December 2022 to December 2021. We'll get more into that in a minute. And then there's also month over month. So there's year over year, there's month over month. Okay, now there's a couple types of words. There's inflation, which is typically meaning the prices are going up. Then there's disinflation, and then there's deflation. So what are we referring to here? We're going to talk about both of these words. Let's take a look at that real quick. Directly from Investopedia, we have deflation is a decrease in general price levels. So that means if inflation is going up, then deflation is prices going down, a decrease in price levels. Disinflation is what happens when price inflation slows. So if it goes up like this and then it slows down, it's still going up, but at a slower level. That's disinflation. If it starts going down, that's deflation. You have to understand that because we use these words. Disinflation, on the other hand, shows the rate of change of inflation. The inflation rate is declining over time, but it remains positive. So it's still going up, just a little bit slower. And so we've seen that the year-over-year CPI is disinflating. It's going back down. We had reached a peak of 9.1% on the CPI, and the last print we just got was 6.45, 6.5%. And so that means it's still going up, but at a slower rate. That's called disinflation. Now, the reason why it's important to break this down is because the Fed is focused on disinflation. They don't want to stop inflation. They just want it to go up at a slower rate, preferably 2%. That's their target. But instead of 2%, we're at 6.45. What they don't want is they don't want deflation. If asset prices are going down, that's a big problem for them. And so what we've seen from 9.1 to 6.45 is the disinflation, which is what they want. They're getting to their point. However, well, let's take a look at that. I have some charts right here. Some of these charts are taken from Joe Consorti, who helps me with research, and his other project, the Bitcoin Layer. We'll link to it down below if you want to check some of that out. But what we can see here is core year over year. Well, we have main CPI 6.45, and we can see that sitting right here. And so in this chart, you can see that inflation went up, and you can see it's coming back down. That's the disinflation. We have the core CPI, which is 5.7 right here, and we'll talk about that in a minute. And so you can kind of visualize exactly what's going on. Now, what's important to understand is the month-over-month CPI is actually in deflation. And remember, the Fed does not want deflation. Now, it's important to understand, if you look at the data here, this is the month-over-month data, and we can see that the headline data is actually negative here. Remember, that's what they do not want. And so while they're fighting to try to get back down, just like they were fighting to try to get to 2%, they couldn't get it, and they overshot to 9. Now they're trying to get back down to 2, but they'll probably overshoot again, and it looks like that's what's happening. They're having deflation. Okay, now all eyes are on risk assets though, all right? And this is the canary in the coal mine that we have to understand. We have to understand that risk assets move before other assets. Risk assets are the tech stocks, the cryptocurrencies, things that are considered risk. And they move first. So what we can see is the Fed started talking about tightening the markets. This was August of 2021. Markets have started adjusting to the Fed's expected policy tightening. So the Fed hadn't even done anything yet, they hadn't even said anything yet, but people were starting to expect that they would. This was August 18th of 2021. Then we can see it finally came. So this is in November 3rd, 2021. The Fed is to begin slowing its pace of asset purchases. The Fed Reserve on Wednesday said it would start slowing its pace of asset purchases, the first step in paring back its easy money policies. So people thought they were going to do it in August, but it was November when they finally said they were going to do it. Now, they didn't actually do anything until the following year, but they said they were going to do it in a couple of months. The Fed is always telling us well in advance. They're projecting out what is going to happen so they don't surprise the market. But let's take a look at this. The NASDAQ, which is mainly the tech stocks, which would be considered the risk assets, started selling off. So what we can see here, the chart of the NASDAQ, the peak right here came on November 23rd, 2021. And when did the Fed say they were going to start doing something? In November. So right after the Fed said they would do something, the NASDAQ peaked. Now remember, they didn't actually do anything until I believe March of 2022. Okay, that's the NASDAQ. We can see the S&P 500, which is not considered risk assets. It peaked here on January 3rd. So you can see risk started sniffing it out, as we say. Risk said, hey, we can see you're going to sell off, and they started moving well in advance of the S&P 500, November 23rd. Now, another risk asset that's even way more sensitive to this is Bitcoin. And take a look at Bitcoin. Bitcoin peaked on November 11th. So Bitcoin got it. Remember, the announcement was November 3rd. Bitcoin started selling off November 11th. The NASDAQ not until November 23rd. So Bitcoin front ran this move on the NASDAQ by a couple of weeks, which both front ran it on the S&P 500 by a couple of months. And so Bitcoin moves ahead of the rest of risk assets like the NASDAQ and certainly like the S&P 500. We can also see it on the Dixie. This is the dollar strength. And so what we can see is that in this time frame, right about here is when the Fed said that they would start going back into a tight money supply. And you can see the dollar had been trending down. It started moving sideways when they made their announcement right here. And since then, the dollar has gotten very, very strong because they're tightening the market, which makes the dollar strong. And so you can understand how the Bitcoin, how dollar, Bitcoin, NASDAQ, and S&P 500 move differently around these easy money policies. So since these types of assets, the risk assets, specifically Bitcoin, move very quickly, they sniff out what the Fed is going to do. Remember, well in advance of any actual movements, it looks like these assets are now starting to finally sniff out the pivot. They're starting to think that the pivot is going to come, and let's get ready. And so what we're talking about is a pre-Fed pause rally. Let's take a look at this. We have someone called the Fed Whisperer. That's Tim Rose. And Tim Rose is basically the mouthpiece for the Fed. They leak him information and he feeds it to the Wall Street Journal so that we finally hear it. Remember, I believe it's known that the Fed doesn't try to sneak up on anybody. The Fed is not trying to hide things. The Fed wants to project it way in advance of what they're doing because they don't want to surprise the markets. And so they leak this information so we get it. And the Fed, the well-known as Fed mouthpiece, Nick Timrose, he says that the Fed will again slash its next rate hike increment, this time from 50 basis points to 25 basis points at the February 1 FOMC meeting. And so they've been raising rates at the fastest, most aggressive pace in history, and it looks like they're finally going to stop coming down from a 75 basis point to a 25 basis point hike. That's what he says right here. He says, AKA, they call him Nicky Leaks. Made sure everybody knows. They're not trying to sneak this on you. They want you to know what's going to happen. Improving inflation data suggests that officials will consider a smaller increase. What inflation data? The data we just looked at. Not only are they getting the big disinflation they want, they're actually starting to get deflation. Remember, they do not want that. And so they're going to have to start moving to take out that risk of that deflation. And so the Fed mouthpiece tells us that. Now, let's take a look at what's happening since we now know, the market now knows the Fed is going to pause, maybe not a full-scale pivot, but at least a pause for right now. Well, we can see since that, the NASDAQ has moved 8% since that news broke. So risk assets, they're starting to sniff this out and they're starting to move. That's the NASDAQ. What about Bitcoin? Bitcoin moves even faster. It's even more sensitive than NASDAQ. And Bitcoin had a 30% move just since that information was leaked. Are you getting what I'm saying here? Let's look at this. Okay, that's Bitcoin. What about ones that are even more susceptible? So we have Coinbase. Coinbase, since that news broke right here, is up over 60%. So these things have leverage. So like sort of like a gold, and then I like to invest in gold miners. So gold, if it goes up by 200 bucks an ounce, that's good, but a gold miner has 1,000,000 ounces times 200 bucks, there's more leverage. That's like what Coinbase does, which is why it's moved so much more. We can see Mara, which is one of the leading publicly traded Bitcoin mining companies, since that news broke, is up 150%. So these are sniffing out that this Fed pause at least is going to happen, and we can see it in the dollar, we can see it in the NASDAQ. Now, what about the S&P 500? Remember, it sort of lags behind, so it's not doing 150% like Mara, it's up only 6%. So it's very, very, very late to the party. Now, for historical purposes, we can see that stocks typically rally when the Fed pauses. Now, I know a lot of you guys have been talking about, and I've talked about as well as my videos, that when the pivot comes, a lot of times that's not good for stocks. Recently, I did a video saying why it's actually not good for stocks. But a pause is different. And so what we can see, except for the year 2000, all the other times, 78, 89, 95, 2000, 2006, and 2018, all the other times, when the Fed paused, the stocks rallied. Okay? So remember, the S&P 500 comes after. It's barely just catching on to this move right now. All right. Now, like I said, Bitcoin moves first. It's sold off first and it's pumping first as well. It's always the first mover. Now, where is Bitcoin going, and is now still a good time to buy, or is it too late? Again, this is from Nick and Joe over at the Bitcoin Layer, but they come up with something called Bitcoin's fair value. And they basically take a couple different indicators, one of which is their 200-week moving average. And then another one is their the price, the cost to mine it, the electricity hash pricing. And so when we take a look at those two, we can see they've come up with a fair market value of about $24,000. And so if you can pick up Bitcoin below $24,000, that's a good value. Now, we don't know the bottoms of markets and we don't know the tops until we look backwards on them. Everybody wants to wait and catch the bottom to catch the falling knives, but that's not how investing works. You buy things when they're cheap. And so what we do know is they're cheap. Anything below $24,000 is historically cheap. And what we can see here from this other chart, we can see that anytime we are able to get them in this area right here, it's gone on to have really big gains. As a matter of fact, this was 1,600% run right here. I believe this was like an 800% run right here. And so when you can pick them up at these levels, like we're sitting right here, it's been historically a historic buying opportunity. We can see in this other chart that Joe put together, what we're watching for is this area right here. So we have this kind of support zone right here. And if Bitcoin can pump up right past here, which is 23K, we will be off to the races. So will it go? We don't know. Is this the beginning of another market, another bull market in stocks? We don't know. We don't know until we're looking backwards. However, what we do know is that the Fed, per the Fed whisperer, is pausing. What we do know is that markets rally when the Fed pauses. What we do know is that Bitcoin, as well as the NASDAQ risk assets, show us the move in advance. They sniff it out. And as we see in the data, Bitcoin, Bitcoin miners, and even the NASDAQ are pumping hard, and S&P 500 is just going along with it. So has the Fed pulled off the proverbial soft landing, and is it time to buy Bitcoin and other risk assets, stocks, etc.? Now here, let me give you a framework to think about this. I've laid this out to you before. Whether it's the S&P 500, whether it's gold, whether it's Bitcoin, whatever asset, fill in the blank. Are you 100% sure that the markets will keep going down? No, of course not. Are you 75% sure? Are you 50% sure in light of the new information that you've been given? So if, let's say that, well, Mark, you're pretty convincing with this data. I used to think it was a 90% chance the markets are going to crash. Now I'll give it a 60% chance. Okay, that means there's a 40% chance it won't crash. So what you may want to do, this is what I'm doing. I have my dry gunpowder, my cash that's been sitting on the sidelines. And if I think there's a 30% or 40% chance the market won't drop anymore, then I'm taking 30 or 40% of my cash and I'm starting to deploy it. Now, it could continue to go down. Maybe I give it a 60 or 70% chance of crashing. So I keep 60 or 70% on the sidelines. That way I can average back in. If the price does dip down, people think Bitcoin's going to 10,000 or 15,000, great. Average in. But if it doesn't, you've at least secured your position and you can average up. Now fill in the blank with XYZ asset, whatever you want to do, but that's the strategy. There's no such thing as certainties. There's no guarantee the markets are going down. And the way that risk assets, the way CPI data is coming, the threat that the Fed has, the proverbial pause that they're having, and the way risk assets are behaving makes me think it's time to get back in. But what do you think? Am I crazy? Or I'm on to something? Let me know in the comments down below. Of course, as always, give me a thumbs up on this video if you like it. If you don't, you can give me a thumbs down, but at least tell me why in the comments. And that's what I got. To your success. I'm out.